All right. So candlesticks, these are the language of the market. And then they tell us whether the market is going up or going down. I think someone has their hand up. If it is not deliberate, kindly put your question in the chat box. Okay, after the meeting, now we'll address it. Okay, put the question in the chat box. I see that someone's hand is up. You can put it in the chat box and I'll address it. Okay, right. So these are what we call the candlesticks. And like I mentioned in my case, I'm using black and white. The default colors are red and green. Okay, so I want to show you that one because you are likely to see this if you open yours. You are likely to see red candles and then green candles. Okay. By default, the green candles are what we call bullish candles. Bullish candles. And then bullish candles means that within that session, the market was going up. Can you unmute your microphone? Someone's microphone is on. Who is that? Omar, is it Sisawo? Can you unmute? Yes, kindly do that. Mute your microphone for us. Thank you. If you have any question, please put it in the chat box. All right. Thank you. Okay. So by default, the green candles are bullish candles, and then the red candles are bearish candles. These are technical terms. What do they mean? It means that the green candles signify when the market was progressing upward. So within the session, over here, I have 24. What it means is that every candle that you see here represents the market activity for 24 hours. Okay. So within that session, whatever the market did, that is what you see here. Okay. So currently, I'm going to zoom out and then put my cursor on one of them, this one. So you see this candle. This is a green candle. So this is a bullish candle. And then look up here, follow my cursor all the way to the top. You see there is O here, there is H here, L, and then C. The O is when the candle opened. The H is the highest point of the candle. The L is the lowest point of the candle, and the C is the where the candle closed. So I'm going to put it back to this candle. Now let's read the opening price and then the closing price. We have that this candle opened at 2,629.04, right? And then the highest of this candle was 2,713. I'm reading these numbers. These numbers. The highest was 2,713.95. All right. And the lowest it went was 2,626. And then it closed at 2,703.0 0.24, right? So this gives us information about the candle. What do we use this for? It tells us exactly where the candle opened or within that particular day, which was on the 13th of November, 2025. So on the 13th of November, the market opened around 2,629.04 and then it closed around 2,703.24. The highest it went was 2,713 and the lowest it went was 2,626. These are key information that we will use later when we are doing the technical analysis. Okay, so for now, we just want you to know the difference between the bullish candles and the bearish candles. That's just it. And I will mention some few characteristics about them. Like I mentioned, we have a complete course on that, which I will give you access to a book that talks more about that. So you read it and then you understand all these things that we are talking about. Okay, so this is for the bullish candle. Now let's observe something. When we look at the opening price, it was what? Here, it was 2,629. Compared to the closing price, which is 2,703. We can see that the opening price was lower than the closing price because this is 2,600 and then that the closing is what 2,700. So obviously the closing is higher than the opening. So what this tells us is that when we have a candle which opening price is lower than the closing price, then we see that candle is a bullish candle. Okay. When we reverse it, that is what? A bearish candle. What this means is that for a bullish candle, the market is what? Going up. That is what it means. And for a bearish candle, the market is going down. So let's look at this bearish candle. This one, that's the candle that formed on Friday, the 21st of November, 2025. The candle opened around 2,727 and then it closed around 2,640. Obviously, there was a decline in price. That is why we call this a bearish candle. That is why we call this a bearish candle. Now, there is a reason they have those names. Bullish stands for the animal bull. Bull. And if you know how bulls or cows, if you know how they fight, normally they will put their horns on the ground and then they will lift the obstacle. They will lift it up. Okay, so you see that they start the process from the ground, which is the bottom, the lowest point, and then they lift the object high, which means they end up in the air. What that means is that they are starting from the bottom and then ending in the air, which is higher. Okay. Now, the bearish also signifies bears. If you know the animal bears, they attack their prey by standing tall. So they stand tall and they crush the prey to the ground. That's what they do. So they crush the prey with their forearm to the ground. So they also start in the air and they end in the ground. Okay. So if you forget what the bullish and the bearish means, just look at how these animals fight and then you understand the scenario. Okay, so we are saying that for the bearish candle, it starts or it opens at a higher price and then it closes at a lower price. You just have to know the difference. That is all. Okay, you just have to know the difference. So what it means is that all the green candles that we see here are bullish candles. All the red candles that we see here are bearish candles. Okay, but now you can see that some of them, the sizes differ. They are not of the same size. The size also tell you a bit about what happened within the session. Now, when you have a big bullish candle like this, what it means is that the bulls were dominant in that market, or it means the buyers were dominant in the market. You can also put it this way: there were more buys. There were a lot of people picking buy entries in that market. That is what it means when you have a big candle like this. Now, when you have a big bearish candle like this, it means there were a lot of sellers in the market during that session. There were a lot of selling activity during that session. That is what it means. Now, I said that you can see there are different sizes. What does it mean to have something like this? Now, let me zoom out this so you can see it well. I'm making emphasis to this candle, the candle that opened on the Saturday, 15th November 2025. You see that it is green, all right, but then it has a very tiny body and has a longer upper wick. We call this the wick, the tiny line that you see. We call it a wick. Some people also call it shadow. Others also refer to it as tail. Any of them, wherever you meet it, is the same thing. Tail, shadow, or wick. Now, this one, you see it has a longer upper wick and then a shorter lower wick with a tiny body. What this means is that although the candle closed as a bullish candle, during the session, the buyers forced price to move all the way to the top, but the sellers took over and they forced the market to close somewhere around the entry, very close to the entry. So it means that the sellers were dominant in this case. Although it is a bullish market, the sellers tried to force the market to close around the opening price. Okay, that is what it means. Now, when you see something like this in the market, it's not just about knowing what the sellers and the buyers were doing. It gives you an idea of what is to come, what is likely to happen. So when you see that the sellers are forcing the buyers to leave the market, it means the sellers are preparing to take over the market. And that explains why in the next few days, we had the market changing from the buy trend toward a sell trend because the sellers showed sign that they were coming into the market. This is a bit technical. I'll bear with you if you don't understand. When we do it over and over again, you will get it. Okay. I want to confirm that you are here with me. So let me see. Okay. Can you still hear me? Type something in the chat box. 111 if you can hear me so I can continue. 111. 111 if you can hear me so that I can continue. Okay, thank you so much. I want us all to get it. That is why I'm doing that. Okay, so this is a bit about the candlesticks. Okay, we have more information about it. In fact, they have various names. We have different candles and then different names, and then they have different meanings as well. There are a lot. If I want to mention all of them, you'll be confused. That is why I said that we just, for now, we want you to know the difference between them, as in the bullish and the bearish, and then a bit about what the style means. I mean, if you have it giving you a smaller body like this, what does it mean? If you have it giving you a longer wick like this, what does it mean? Okay, that's what we want you to understand. Then I'll give you access to the book I'm talking about. Read it so you know a lot about the candlesticks. Okay. All right. So now I want to go to the market structure. Right. So we mentioned that we will be buying and selling. We'll be buying and selling. How do we sell? How do we buy? When do we buy? And then when do we sell? Where do we buy and where do we sell? It's very important. It is very important. So we are going to teach you the when, the where, and the how. We are going to teach you all of that. Okay. So now I want to take you back to this chart. Okay. By the way, the various what do you call it, market structures, we refer to them as charts. So what I have here is Euro USD. So this is the chart or the data for Euro USD. So this tells us what the market did within this period. What I have on the chart, okay, it tells us what happened in the market within that period. Okay, so I'm talking about between 12 November 2025 and today. What happened in the market? That's what we see on my screen now. Okay, so we have three types of market structures. We have three types, and then I want to take you through all of them. So we have the trending. We have the trending. So one is the trending markets. Trending markets. And then two, we have ranging markets. And the third one is choppy markets. Okay, so we will emphasize more on the trending market, although we will mention a thing or two about the other markets, but we will talk more about the trending market because we are going to trade the trending market. So for the trending market, we have two types. We have either the uptrend, and then the downtrend. What this means is that it's either the market is going up or it is going down. For the uptrending market, that is what it means. It's either the market is going up or it is going down. Okay, so let's look at it. Let's look at it. So for the uptrend, we are likely to see something like this. We are likely to see the market starting from a lower region and then going into a higher region. So we are likely to see something like this. Okay, in the uptrending market, we are likely to see something like this. What do we mean by it's moving from a lower region to a higher region? Now look at my cursor. Okay, observe it well. When I place it here, let's try to read the price of from the right side. Okay, this one. I'm talking about this side. Let's read the price. It is 1.16070, okay, or 1.1607. Now let me take it up there and see the price over there. It is 1.1930. Now, if we compare the two figures, obviously, this one, the final price, is bigger than the initial price. This one is bigger than the first price that I read. It means that the market has left the lower prices and it has moved into the higher prices. This is what we call an uptrend. Okay, we have a formal way of defining it, but then this is a literal way to define it so you understand. When the market moves from a lower price to a higher price, that is an uptrend. Let me give you a typical example. So I told you that at the time I prepared the document on what do you call it? Financial market. The dollar to Gambian the last year was 65. So $1 was equal to 65 Gambian the last year as at the time I did it. So I think currently it is around 75 or so. It means it has left 65 to 75. Obviously, there has been what an appreciation. That is what we call an uptrend. You can see that the value has gained, like it has gained value. It didn't depreciate, it didn't go down, it rather went up. That is what we call an uptrend. So this is the Euro USD, which means that as at that time, 1 euro was equivalent to 1.1608 US dollars. But as it stands now, it is around 1.1934, which has seen a significant increase. So this is what an uptrend. Okay, if we are able to compare this to our local currencies, then we understand it better. You get it. Okay, I want to believe that you get this one. If you have any question, jot it somewhere. I'll give you the chance to ask your questions. Okay, I will not go deep into it. I will pause at a point so you can ask your question. So that in our next meeting we will continue. Other than that, you will get confused on the way. Okay, but then I want you to know the various trends that we have. All right. So the next trend that I want us to look at is what we call the downtrend. So for the downtrend, it also starts from a higher zone and then it goes into a lower zone. So something like this, like you are seeing here. Okay. It does something like this. And this is what we mean by that. So let me put my line here. Now around where I started from, the price was 1.1807. And then the final price is what? 1.1558. Obviously, if you compare the two numbers, this is higher than what? This one. It means that the market started from a higher price and it declined to what? A lower price. That has seen a decline. It has seen a depreciation. So we see the market is in a downtrend. It is dropping in value. Typical example, as it stands now, at the dollar to the Gambian Dalasi is 73.75. Between that, let's pick 75. So let's say we wake up tomorrow and then it has dropped to say 60. What it means is the market has depreciated. The value of the dollar to the Lassie has depreciated. Okay, and that is what a downtrend. That is what it means. So for an uptrend, the market, the particular asset we are looking at, the particular currency we are looking at, is seeing a significant increase. And for a downtrend, it is seeing a significant decrease. So there is a rise in price in the uptrend, and there is a decline in price in the downtrend. That is what it means. That is what it means. Now, I want us to look at the ranging markets, and then we also look at the choppy market, and then maybe we will see live examples on the charts. Okay. So for the ranging market, you are likely to see something like this. You see price doing something like this. Okay. You are likely to see price doing something like this. Now, what is happening here? We can see that although we cannot tell the trend of this market, whether it is going up or down, we cannot tell. But we can tell that it is moving within a specific region. And it looks like all the highs are colliding or aligning around the same price, and all the lows are aligning around the same low. So we call here equal highs, and we call this side equal lows. Equal highs and then equal lows. So when it goes up, it goes around a specific figure. And whenever the market goes up there, it aligns around that figure. If it is doing something like that, then we say that the market is ranging. It means the market is trapped within a specific range. It is not going outside that. A typical example, let's say that between March and December, the Gambian Dalasi has been moving between the prices 65 and then 75. It has never gone beyond 65 or above, what do you call this? Um, 75. If it has been doing that, then we say that the price is ranging. It is moving within a specific limit. It is not going beyond that limit. If that thing happens, we say the market is what? Ranging. Okay. Now, when it is like that, you can take advantage of it, all right, but then it is not recommended because if you don't really know the range, if you don't know the limits, you will make mistakes, and before you know, you lose your money. Okay. So that is why I said we will spend most of our time dwelling on the trending market, the uptrend, the downtrend. For that one, it is very clear. But for the ranging, it isn't that obvious. Okay. And then the last one is the choppy market. Now, the choppy market, we are never going to trade within a choppy market because that doesn't give us a clear direction. So we don't know what is actually happening. Okay, so we are likely to see something like this. Price is rough, it's very rough. It doesn't really give you any pattern, right? You don't see any clear pattern. So you see that the market is moving anyhow. It is not within a defined limit or region. It's not within that. It's not in a clear uptrend or a clear downtrend. It's just moving anyhow. When it is like that, we say it is choppy. Some people call it consolidation. When it is like that, because we can't tell the trend of the market, it is advisable that we avoid such market because if you trade it, you are likely to lose your money. Okay, so if nothing at all, today you should remember that we have two main types of candlesticks. Okay, we have the bullish candlestick, which signifies appreciation or an uptrend, and the bearish candlesticks, which signify depreciation, which is what? A sell or downtrend. Okay. Then we said we have three main types of market structure. We have the trending market, which comprises of the uptrend and the downtrend. Then we have the ranging market, and the last one is the choppy market. We can trade in the trending market. For in an uptrend, what we do is that we buy. I'll explain this later when we go into details. I'll explain why we buy in an uptrend. Then in a downtrend, we sell. I'll explain that one as well. Then in a ranging market, normally we buy around the equal lows and then we sell around the equal highs. I'll explain that also further. So if nothing at all, you should be able to remember these few things. Okay. So before we go, I want to show you how it appears on the chart. Okay. How it appears on the chart. So what I have on the screen now, I'm not going to quiz you. I'm going to tell you the trend. When I look at this, I should be able to tell the trend of this market. And because I have done this for a long time, I know that this is an uptrend. Why? Because when I observe where the market started from, it started from here. Okay, here. The price was around 1.15029. And then it has moved all the way to 1.1802. I know that if I should subtract the two numbers, I'm likely to have a positive figure because this is what? An appreciation. The market has moved from a lower price to a higher price. So this is obviously an uptrend. If you want to know it well, just try and then do what I showed you. You know, I said the market does something like this. It goes up and down. It goes up and down. It goes up and down. So if you're able to identify something like this, then you know that obviously this is what? An uptrend. So as it stands now, it is an uptrend. Now, bear in mind, it is not going to be as perfect as what we did over there because that one is theory. With the practicals, you will see the trend all right, but it's not going to be as perfect as that. So this is obviously an uptrend because it's moving from what? A lower region into an upper, a higher region, sorry. So this is what? An uptrend. Okay. The same market, we are going to observe when it was in a downtrend. Okay. Now look at it. This same market, look at it from this side. Now, when you look at the behavior from this side, okay, to this side, it is clear that this is what? This side. I'm talking about only this side, okay? Only this region. What I have in the box, I'm talking about that one. And we can see that it moves from what? 1.1727 all the way to 1.1474. And this is what? A depreciation. So this side was what? A downtrend. This side was what? A downtrend. So that's how you are going to be able to identify that. Okay, so we have downtrend coming in. I want us to identify more of that. So here, this side too was what? A downtrend. This was a downtrend. And then this side is what? We can see that price is going up. Okay, look at this very well. I mean this. You see, it started from the lower region into an upper region. So this is an uptrend. Okay. Yes. So that is how we identify that we have a downtrend happening here, and then we have a clear uptrend here. We see market moving all the way to the top, from the bottom to the top, here from the top to the bottom. So this is a downtrend. This is also an uptrend. So that's how the market moves. At some point, it moves in an uptrend. At some point, it moves in a downtrend. At some point, it ranges. And at some point, it consolidates. Okay. When it happens like that, we say that we say whether it is an uptrend or a downtrend, consolidation or a ranging market. So around here, you see that before it continued the uptrending, it's consolidated here before it went up. The same thing happened here. Before it went up again, it consolidated. How do we define the consolidation? So you see that around that zone, the candles are packed. They are packed together, and you can't really tell the highs from the lows. They are confusing. When you see it like that, it's consolidating. Then that's what we said that we are going to avoid. We are not going to trade that. So yeah, that is how the market moves. Okay, that is how it moves. All right, let me look at Deriv synthetic indices to see if you have a clear example. Yeah. Okay. So we see that from here, from this side, we had the market going up. And then as it stands now, the market is going down. As you can see here, it is going up. So if I should go to a much lower time frame, you will see it well. You see the trend. Okay. So you can see that it's going down, like it goes up and then it goes down, goes up, goes down like that. Okay. And then it keeps dropping. So this side, what is happening now is a downtrend. It is selling. Okay. Yes. Let's see other. Okay. So this is also a downtrend. We can see it is moving from a lower region, sorry, a higher region into a lower region. So this is a downtrend, and you can see the up and down thing. Okay. Now, this is just a literal way to see whether it is an uptrend or a downtrend. Just look at it. If it is dropping from the left corner to the right corner, dropping, the term is dropping. If it is doing that, we say it is a downtrend. If it is rising from the left corner to the right corner, then it is what an uptrend. That is a layman way of defining an uptrend and a downtrend. There is a technical way to define that. I'm not going to treat that today. In our next meeting, I'll teach you how to properly define an uptrend and a downtrend so that we can start trading with our demo. The moment we are able to identify that, we can start playing with the demo accounts. Okay. So that is going to be our next session. And you are going to tell us when we can have that session. If you want it tomorrow, we can do it so that we'll give you some break to enjoy the festive season. And then maybe we'll continue during the weekend. Or if you are okay with tomorrow, let us know so we can continue with that. At least when we get to that point, you can start with the practice and then we will go into details later. Let me stop the recording.